Do you want a financially secure future, not just for yourself, but for your loved ones as well? This is Generations of Wealth, the podcast that breaks down the most effective wealth building strategies you can easily apply to your own life. Join investor and international best-selling author Derek Dombeck in exploring practical tips and sound advice on building a profitable business, creating a powerful brand, or getting into the thriving world of real estate investing. This is your chance to create your very own financial roadmap to live your vision, love your life. Let's begin this discussion with your host, Derek Dombeck.
Welcome to the Generations of Wealth podcast. I'm your host, Derek Dombeck, and today's show, we're talking with Aaron Chapman, and Aaron has been in the mortgage industry for decades, and he has got an awesome take on what's going to happen with interest rates, what drives interest rates, and it's not what most people think. And he's going to share an actual chart that he put together tracking all the way back for 20, 30 years to show why we are where we are and what's going to happen. On top of that, we talk a lot about inflation and the importance of getting long-term interest rates, 30-year fixed, and buy and hold your real estate. But before I bring Aaron on, just want to bring up, if you are missing any of the shows we've released, or you're interested in our No Means Not Yet negotiations training, the Circle of Trust Mastermind, the Generations of Wealth Voyage, our conference at sea, you can find all of this at thegenerationsofwealth.com. You can also get my two books, Next Level Your Life and The Transformational Journey. So one-stop shop at thegenerationsofwealth.com. And now let's bring on Aaron Chapman. Well, today we got Aaron Chapman with us, and from the conversation we've had prior to recording today, I have no doubt this is going to be not only informational and awesome that way, but a hell of a lot of fun. So he's got a TikTok handle called the Redneck Mortgage Broker, so I knew we were going to get along really well right away. So Aaron, man, can you just tell the Generations of Wealth audience a little bit about yourself, and let's just jump right in.
Well, thanks, Derek. I appreciate you letting me on, and I'm hoping that the TikTok handle is what swayed your decision. Because honestly, what's funny about that is I didn't know what my handle was until you brought it up. I've got staff members that just put it all together. So apparently that's what they think I am. I do have a book coming out later this year titled Redneck Economics, and there's just a lot of wisdom in the experience of people that go through the simpler life. Right? I grew up doing the cattle ranching thing in the early '90s. You spent some time dealing with that same kind of thing as we talked about, the buck and bulls. And there's a simple formula that is found when you're talking about the agricultural world that we can easily put to work in the really complicated business world, but people love to make it more complicated than it needs to be. So right now I do loans for your real estate investors. Now I do loans for everybody out there. I got in the industry in 1997 through a wild way of getting in there. Is really because I couldn't find a job doing anything else, and I was desperate and I was broke, and I had to go through a massive scenario to get there. But once I got there and started understanding real estate investors and what their target was, I started seeing the value in helping them to be successful from the finance side. Because what I found the banking industry has done is really sucked at helping them out from the time I got into it, even till now. The people that jump in that want to help real estate investors, in my opinion, I'm not trying to be a prick here, but they're opportunivores. I'm like, that's the only real business that's working right now, so let's go help those guys. Man, I've been working with investors since 2003 and finding ways to help them when the industry was actually I got practically fired from places. I got pipelines shut down and denied because they didn't want to help the real estate investor. To me, the real estate investor buying single families and then into the duplexes, triplexes, fourplexes, and into multi-units, they're going to be what keeps our economy alive, and they're going to need them. And they only need them when the banks are in pain. I think they need them all the time, and we need to back them up better than we ever have.
Yeah, absolutely. Aaron, how did you fare during the 2006 through 2009 era?
That was another interesting time in my existence. So I was working for Countrywide at that time. I've been with Countrywide since 2001, or just actually 2002. And I was writing a ton of business, man. Life was really good. And then 2008 was coming around. You get into that 2007 and 2008, it was getting harder and harder. But I still had a good amount of business where I had a decent six-figure income coming in into 2008. Well, then August 8th of 2008 comes along, and I was working with these guys, basically taking an English double-decker bus and turned it into a mobile strip club. I got a background of fabrication, working in the oil fields of Wyoming right after high school. And so I'm working, literally sleeping 4 hours a night for like a month. Eight's my lucky number. So I'm jumping on the bike. I'm heading out of town for 3 days. I'm going to take August 8th, which was a Friday, and I'm going to take that Saturday and Sunday. I'm going to ride through Reserve, New Mexico, and come back into the Phoenix Valley and go back to work. I'm not 15 minutes into that ride, and a 17-year-old, his dad's truck, takes me out at 80 plus miles an hour. Now, this is the Arizona freeway at 12:24 in the afternoon. Now, I don't recommend laying on that at all for any length of time, but I had to lay there for a little bit of time because they sent emergency services to get to me 2 exits up because of how much the freeway was blocked from that. And it took them, it could be 10, 15 minutes to get to me. And they had to carry me to the hospital thinking that I was not going to make it. But I came out of that. So I went into that scenario, 190 pounds. I was running marathons. I was rock climbing. I was doing all kinds of cool stuff, really physical. I was worth about $3 to $4 million. But I wheeled out of the hospital weeks later in a wheelchair at 156 pounds with a negative net worth of 1.5 million and a memory that would recycle every 3 to 4 minutes. So I had to come back into an obliterated industry, a skeleton of who I was before, in a wheelchair, learned how to walk again, but then I had to train my brain again. So as I'm getting back into this, everything's obliterated. There was 2 people still doing business that I did business with before. One happened to be my mother. She was doing a lot of short sales at the time. She pivoted her real estate business. And the other was a gal named CJ with Coldwell Banker at the time. And she kept her business alive. By their grace and the grace of God was I able to step forward and take those phone calls when they would send them to me, say, hey, you need to write this person down and call them. And then they call me back 5 minutes later. Hey, did you write that down? I'm like, write what down? So get your pad, get your paper, and they'd help me write things down and remind me. Then I call the borrower and I talk them through the thing, and I hand the notes off to somebody within my branch or my team or the next step to keep things moving along. Well, sometimes I would not cross out what I had written down on the notepad, and I'm thinking, I need to call this person. And I call them up, say, hey, I'm Aaron Chapman with such and such mortgage company. Like, we already talked. I'm like, oh, we did? And she goes, yeah, 10 minutes ago. I'm like, well, let me explain what's going on. And then I had to explain to them how they're going to trust their largest transaction of their life to a guy who can't remember 3 minutes. So it was an interesting crawl back, but that exercise got to where I get get that reconnection in my brain. I don't have that problem as much anymore. Now I have a very, very forgetful memory, but it got to a point where I was able to build myself back up and get to where I got in the industry now. So now, this last year, in the last 2 years, I've been ranked in the top 50 in the United States of over 300,000 people that do my job. Number 1 in the real estate investment lending space for conventional lending for the last several years.
So there's so much to talk about there. I guess going back, when you said your mom was in the short sale space, like, did you get into your own investments real estate wise, or was it just staying in the mortgage industry?
I was already in my own real estate investments prior to that. I started buying real estate in 2001 and investing around the Phoenix Valley. But then when the crash happened, it obliterated everybody, right? I couldn't hold on to anything. And so, as I'm sitting there in my wheelchair, taking phone calls from creditors that wanted to foreclose or do short sales with what I had, it was an easier conversation than the average person at that time. So they would call me and say, hey, what's going on here? Why aren't you making your payments? And then I'd ask them, do you have a fax number? They give me the fax number. I'd fax them my first week's medical bills. That was $1.7 million for my first week in the hospital. They literally calm down and say, okay, how can we help you? So it went from, hey, you owe us money and we're going to send somebody after you to break your legs, to, hey, what can we do to help you out? Because I'm like, my legs are already broken. So they're going to then help guide me through it. And actually, I was able to get a lot of these things, the short sales done, still there was foreclosures. My credit score went from high 700s to 460. But then I got out of it really quickly. I settled a lot of those debts with a few bucks that I had in the bank. I was able to negotiate with all my creditors, and I came at it with really just debt-free when I left that scenario in 2009. I'm coming in 2009 and 10 debt-free. I was able to retain my house, retain a car, or 2 cars. I didn't have to file bankruptcy, and I started over at that point. Now we have real estate in 6 states. My family utilizes the infinite banking strategy with whole life policies for every member of my family, 2 policies on me, 1 on each member of my family. And then when they get married, they get their own policies. And then we use the family trust to buy real estate. Every person within the family, including myself, rents from the trust on the houses that we live in. I have control of the trust because it's all my capital that built it. But we have to meet monthly as a family to understand what do we have, what are we doing, and how are we going to continue to maintain it. And if something happens to me, you're going to get a windfall of capital. What do you do with it? So it's continued to perpetuate what we're constructing and put their mindset right now with their infinite banking strategies and where they're living and how they're paying it and how they're holding each other accountable, so that there will be generations of wealth going forward, and it's not going to be obliterated by children.
Well, I love the fact that you're doing that with the children. And so I have a very similar story through 2007, 8, 9, very similar to yours, except I ultimately did get forced into bankruptcy at the end of it. But the generations of wealth portion, like what I've always been very open with my children about is anything financial. I mean, we don't have to go into the little finite details with them, but they need to understand when things are going well, when things are not going well, and what happens when mom and dad aren't here anymore. So I love that's the direction you took your own family.
It's been an interesting venture. We had the youngest at one point, I think, when we got into this, was 9. She's now 17, and she would actually reach out to my guy who wrote my life insurance policies for me and have conversations with him via text, like, how do you do this and this and this? And he's like, dude, if we could get 9-year-olds to ask questions like this across the country, it'd change the trajectory of our country's future all the way across the board. So that's what I'm hoping to do, is just by little comments or little data or even the book and whatever, just helping people to open up and talk about it. What's funny is how often people don't want to talk about their finances. They definitely don't want to share them with their kids, the struggles that they have. How often people would rather go out and buy the knockoff whatever so they look like they have money. There's the majority of people on this planet, 98% of the people on this planet are working their ass off day to day to try and just keep above the drowning line. And then maybe that's a high percentage. I may be off a little bit. Maybe it's 90%, maybe it's 80%. I don't know. But there's a large percent of people, and they're trying to pretend like they have more than they do. There's no shame in not having it right now. There's shame in being stupid with it and putting yourself in a position where you're always going to be crawling for it, and there's nothing left when you're out. Now, there's the other thought process where people say, well, I'm trying to save $200, $300, $500, $1,000 a month and set it aside for my kids. Why? Use that capital, build things, live a life. That's why I get the whole life policy. So I have life insurance. I can have a life. I'm not utilizing the capital. I'm going to use every damn cent I have available to me. And I hope when I go out, and I hope I go out on a bear hunt with a pistol, but when I go out, I want to have been able to use every single resource I had available to me. And if my bank accounts are freaking zero, when I die, the death benefit that comes piling in, they know what to do with it. They will be wealthier than I am now or ever will be based upon what I set up for them.
Absolutely. Absolutely. But they're getting the financial education now, which is the important part, because like we have our trust set up to where my kids, and I have kids that are separated in age quite a bit due to adoption. So my soon to be 18-year-old versus my 6-year-old, depending on when I pass, that could be completely different. If they get this huge windfall of money, ours is set up where they've got parameters. They've got to be contributing members of society. They've got to be gainfully employed or running a business, right? There's other things, because I'm not an advocate for just handing an uneducated youth a big shitload of money and say, have fun, go, blow it on whatever, right?
Yeah, exactly. You end up having supercars that won't run anymore because they can't maintain it because they blew it all on them. I can't have that. And then also the fact that you're just watching them kind of live their life and turning them loose. I remember when I first shared with my kids our financial picture, right? Here's my income. Here's our assets. Here's where we have capital at and all these things. They all almost in unison looked at me and was like, then why do we live here? Like, because you are not going to have a better child than I had as far as where we're living. You're going to understand what it is to live in this particular environment. Plus, I don't give a shit about a big ass house. At the time, we had a 3-bedroom, 2-bath with 4 kids. Big damn deal. Right now, I bought the house next door, rehabbed it, a lot more space. Now I have my daughter with her husband, my grandchildren living right next door where they grew up. Mm-hmm. It's a really cool existence. And if I ever have a castle on the hill, I don't think I ever will. I don't think I give a crap about that. But if I do, and my kids come to visit, they're going to meet me at Circle K. They're going to put a hood on, and then I'm going to take them up because they're not going to know where I freaking live. I don't want them to see that don't have that access to that till I'm gone.
Absolutely. Absolutely. Well, I'm curious about, with your background in lending and everything else, everybody is always a an expert on what's going to happen with interest rates. It's an election year, so that's going to have a big effect. They're going to drop them right before the election. Like all these rumors and bullshit flies everywhere. So what's your take on what drives long-term interest rates?
Well, rumors and bullshit is 100% correct when you come to that. And I spend a lot of time in a lot of stages, and I'll ask that question: what drives interest rates? And everybody's like, "Oh, it's the Fed, or the 10-year, or inflation, or all these different answers." I'm like, well, some of them are all partially correct. They're all a piece of it. But in reality, it's go back. I tell everybody, go watch the movie The Big Short. It tells you about the history of the mortgage-backed security. What all lending ever was, or especially when it comes to mortgages, was a local bank offering interest return on a checking account, savings account, and CDs. And the locals would put their money with their bank. They would get payback interest on their checking accounts, savings accounts, and CDs, which back then it could be 3 to 4% on your checking, 5 to 6% on your savings, and 8+% on your CD. But they're loaning the money back to you, your money. They'd house it, pay you a nominal rate of return, then loan it back to you, or the community's money back to anybody who borrowed it at 12, 14, 18%, right? So there was a massive margin there. Then you got the Luteranary from Solomon Brothers says, hey, why are we leaving this on a local basis? Why can't this be a global thing? Why can't this be a large national thing? So they created the mortgage-backed security in the bond market where pension funds and hedge funds can lend and put their money in there and expect a certain rate of return. And in that example on that movie, they showed them sitting in a conference room with an overhead projector. And the famous words are, "Who the hell doesn't pay your mortgage?" I think those guys put $25 million in, and then they went and had drinks. Well, the problem that happened then is you got to where everybody's borrowing, but everybody's paying it back slowly. And they're not, there was a generation that lived in the same house until they died. My grandmother died in the same house that she was in before I was born. My mother was in high school in that home. That generation wasn't moving a lot. So in the 90s, they had to get more creative and created these other types of instruments where you can borrow money with no money, with sometimes no money down. You can do it with no income qualifying, no asset qualifying. And then it created the crash. So when the crash happened, you had quantitative easing. Now, let me see if I can do a screen share here, because I want to be able to show you something that you can see what's going on with that whole quantitative easing thought process, so people understand what drove our interest rates to where they were. Because people think there's a cycle going on here. And they think there's a cycle, they're thinking, okay, the cycle is going to come back around and we're going to get these low interest rates again. Not going to happen. This is not a cycle that we're in. We're in the average interest rates where we should be. Now, this is a very complicated looking chart. This is the universal mortgage-backed security. This is what they call the 5.5 coupon. Anybody puts their money into this, they're going to make about 5.5% on their money. Now, we're going to just go right. I'm going to have to try and zoom in over here. Actually, I'm going to have to get out of this one. Problem that I've got here is my ability to zoom on this makes it a little complicated. So I don't know if you can see very much in this, but right here, all the way back in November of 2008 is when the Federal Reserve came out and said, we're going to do what they call quantitative easing. They announced it in November 2008. They didn't actually start doing it till January 2009, which is illustrated right here. This orange line. The yellow line is the announcement date, all the way back here in 2008. January 2009 is the actual date they start putting money in. Look at the difference here. That gap means a whole bunch of money flooded in and started going into those bonds, packing the bonds full of money. As the bonds go up, more money goes in, interest rates go down. Why did it get full of money at that time? It got full of money at that time because of the fact that the mortgage-backed securities were driving. But let's put it this way. It's kind of like you and I going out to dinner, and we're sitting next to, and a couple guys in three-piece suits showed up, and they started ordering. And as they're talking, we hear that they are actually going to invest $100 million into some sort of stock. What are we going to do when we hear that?
We're going to go look at that stock.
We're literally calling our Schwab guy and saying, buy all that stock, sell everything else, buy that stock. Well, that's exactly what they did. I've got a little bit of better zoom in right now so I can show this. So they all jumped in, and this is what happened. All this capital flowing into it. Then the Fed started putting money in. This is the U.S. Treasury under Hank Paulson, printing money, filtering it through Ben Bernanke on the Fed, and then dumping into the market. This represents $8.9 trillion right here, up until this point. Now, we had this last weekend, the stuff going on with the assassination attempt on Trump, and there's all these people saying it's going to kill the markets. We're going to have all kinds of inflation if Trump gets in. Well, we see what happened with the assassination attempt. We saw a record jump in the Dow. Well, if we look right here, this is actually the election day back in 2016, right there. And we see mortgage-backed securities dropped, and they continued to drop because they tried quantitative easing after the election of Donald Trump. And when it was speculation that if Trump got in office in 2016, the stock market would fall. It didn't fall; it spiked. Mm-hmm. It jumped up. It was actually started on its biggest bull run we'd had in a long time. But when money leaves, money goes into stocks. It's got to come from somewhere. It came from bonds, as we saw the bonds fell. When these fall, rates go up, and we saw a big rate jump from 2016 up until the end of 2018. And then you start into the quantitative. Then they started having to figure out we've got to do a little bit different here than the quantitative tightening. We're going to reinvest. And then you had COVID, and then it jumped even more. And this is where we got into the 2%. Now we start the actual quantitative tightening where the Federal Reserve says we're going to stop putting money into it, period. That was the end of October 2021, and it fell off a freaking cliff. And because of that fall off of a cliff, we get to see the interest rates dropping, at least, you see here, I'm trying to get this chart. Here we go. You see the interest rates rising at an enormous level over this period of time until we pass through these lines. Remember those lines we talked about where the Fed started investing in quantitative easing? We passed through that one. We passed through the line where they announced they were going to do quantitative easing, and we went below it. We bottomed out in October. And I got to think when everybody's saying, they're saying, when is the interest rates going to go down again back into the fives? I'm like, I don't believe they ever will, because they only went down because of quantitative easing. So I went and I drew this out. That was when I drew this out. It was way back here in 2023. It was early 2023, and I drew this out. I'm like, I'm thinking that that's our level. It's going to break through that, and I don't think it'll reasonably get above it. It broke it. Came back down. It was stuck between the two. Came back down. It hit to its worst level since 1996 at the end of October 2023, and then it started to rocket up because they started reporting the jobs a little bit more accurate they had. They've been bullshitting our jobs report up to this point to make our current administration look good, and that's why money was flowing out of the bonds and going to stocks saying our economy is going to do awesome because all these job creation. It wasn't job creation. It was post-COVID. It's not job creation. So post-COVID, people going back to work, it wasn't creation of jobs. Then they started actually looking at real job reports, and it rocketed up, meaning money flowing into mortgage-backed securities because, like, wait a minute, the economy is really weak. We want to put it into a safe place. And where did it stop? Stopped right on that freaking line, the announcement of quantitative easing. Why did it stop there? Because there's not enough capital to go in there beyond what the market's willing to give. It stopped there, and I'm going to zoom in on it a little bit more so you guys can see it. Stopped on that level, and it kept hitting that level, and it started in a downward channel. And I follow these channels because what it did is I drew these channels out early on, and I watched it just bang around that channel because that's where your investors are like, when it reaches certain points, I think others might buy. When it reaches other points, others might sell, so they're trying to be ahead of it so they can make money. But now we have what's happened with Donald Trump. We've had what's happening with a lot of negative economic data coming out, pushing us up into these levels. And I think this is where we're going to be. This is going to be our peak. I don't see our interest rates getting any better than maybe 0.5% lower than where we're at right now. So if you're looking at the rates today and it's like, I'm going to wait until they get 2%. I don't think it's going to happen again. It could. I'm not saying that they won't. They've already done stupid shit to be destructive to our economy. Why would they not do more stupid shit? If there's anything that our government has proven is they will do stupid shit. You've got their current chairman of the Fed, Jerome Powell, who's in the recent probably 6-8 months has said the one thing we do know about inflation is we don't know enough about inflation. So because of all these things, I can't say what they're going to do. I personally don't anticipate they'll lower the rates more than maybe one time this year. Maybe. If it was me and somebody said, Aaron Chapman, you're now the chairman of the Fed for 2 days, what are you going to do? Mike, I'm raising freaking rate. We got to get this more under control. We got to slow this down. People are not stopping their buying. We built a consumer-based economy that needs that tickle to push the buy button. How many people do you know have freaking Amazon showing up every damn day at their door and they have boxes unopened in their house?
Oh, absolutely.
Because it's not about what they bought. It was the feeling they got by buying it. That's the problem we have today. And until we get that under control, we're going to have inflation. Now, when we're talking about inflation, what we've got coming, there's readings out there. We just had the producer price index come out. It was way hotter than they anticipated. People are thinking the CPI is going to go down, and that's going to bring down interest rates. The producer price index is where it all starts. If the production of the goods and services that we have, and that's going up in cost, don't we think that the actual consumption is going to go up in cost? In reality, inflation is more not a matter of goods goods and services becoming more expensive. It's the fact that the dollar is losing value. And because the dollar is losing value so much, people need to understand how that affects them as an investor. So looking at these interest rates, we just saw the rates, I don't believe we're going to go down more than 0.5% below that. So a couple key points. Let's say they didn't. Let's say you sat here on your ass like, I'm not going to invest in real estate till the rates go down to, say, 4%. And let's say they did. How many people are sitting on the sidelines waiting to get on the field when the rates go down to 4? An enormous amount of people. What do you think the pricing of housing is going to do?
It'll skyrocket.
Going to go through the freaking roof. We already saw that. We should not see prices of houses right now at the level that they are. A $400,000 house in Arizona is like 1,300 square feet. That's freaking stupid. That's a $100,000 house or $150,000 house. It's because the amount of supply of capital we have. Let's illustrate this a little bit better. 1994, I walked into my very first Taco Bell. Never walked into one before that. I looked at their value menu. I could buy 2 bean burritos, 2 crunchy tacos, and a drink for $1.99. Mm-hmm. Fast forward to 2023. I drove through a Taco Bell in November of 2023 with my 17-year-old, getting ready to take her back to the school for afternoon, whatever crap she was doing after school. And she said she wants 2 crunchy tacos, 2 bean burritos, and a drink. What do you think I paid for that?
Well, that's $14.
$14.90 some odd cents is almost $15. That's a 750% swing in cost since in 30 years. So what does that mean? Did burrito construction become that much more expensive over that period of time? No. The value of the U.S. dollar dropped that much. Here's another example if you don't believe me. In 1920s and before, they had mint a 1-ounce gold piece. I have a couple of them. If I was thinking, I brought it out here. 1-ounce gold piece. You could go into a department store and you get a $20 gold piece, buy a hat, a shirt, a tie, a belt, a pair of shoes, a pair of socks, and a suit for that $20. Right now, I can't buy the socks I'm wearing for $20. But I could go into a department store and buy all that stuff with an ounce of gold. Why? Because the value of an ounce of gold is equal to the cost of all those things. The value of the gold has not gone up. The cost of those goods has not gone up. The instrument that we exchange for has gone down that much. So when you recalculate the value of your dollar over a 30-year period, when you're getting a mortgage on a house, you need to rethink how you're paying back your mortgage. It doesn't matter the interest rate. What you're thinking about is your cost structure and how you can offload that cost to somebody else. So we're going to do a little bit of math real quick, Eric. We're going to pretend you're a brand new real estate investor, and we're going to pretend you're buying a $200,000 investment property and you're putting 20% down. And let's say you're going to make $1,800 a month rent on this $200,000 house. You've got a 30-year fixed mortgage at about 7.6%, and you're only making $100 a month cash flow. Does that sound like a good deal to you?
On the surface, no, not from a cash flow perspective. However, the spread out over the fixed rate of 30 years, that's where it becomes appealing to me.
It starts to become a lot more appealing. So let's grab your phone. Let's do a quick little bit of calculation here so we can show what people should really be looking at. Because on the cash flow perspective, when you're talking about investing in single families, people are like, oh, my cash on cash returns and my cap rates. And that's what they're really focused on. Well, rates got to go down so I can get my cash on cash return back up. But I tell them, can you keep that property reasonably rented for the entire time you own it? And can you get at least 2.5% appreciation? And can you raise rents? Then let's do those calculations. So we got that $200,000 house. You're putting 20% down. How much is that?
$40,000.
$40,000. That's your investment. You invested $40,000. This is your investment into your business. And let's say it's a shitty time in the market. You're getting a 7.6% rate. That's not what we're talking about here today, guys. Just letting you know, we've seen that. We might see it again. It's lower than that today. 7.6%. Let's say there's points and there's costs here at $10,000 in cost. This is round numbers. So you got $10,000 in total costs and points and taxes and insurance plus $40,000. How much are you investing?
$50,000.
$50,000 invested. Okay. Now, we said you found a property and keep reasonably rented the entire time you own it. You'll be able to raise rent, you get appreciation. Who's paying back the $160,000?
The tenants.
The tenants. So let's take $160,000 and divide it by 30, and what do you get?
$5,333.
$5,333. What that means, guys, is that you are over 30 years. It's an average because you have an amortization table. Your tenants is giving you basically $5,333.33 per year to pay off your mortgage. Now, you invested $50,000 and you're paying off this $160,000 partner of yours. How much is your investment going up by percentage-wise? If you got $50,000 invested and they're giving you $5,300, what percentage is your $50,000 going up by every year?
Well, top of my head, that's 10%.
10.66 to be exact. 10.66%, guys. just by somebody paying off your mortgage. If you didn't pull a single dollar out of your pocket to maintain that house, and you didn't bring a single dollar of cash flow in, you're making 10.6. Now let's talk about appreciation. Do you know how much houses are appreciating right now in the United States?
Nationwide, I do not know what the average is currently.
Schiller, Black Knight, CoreLogic said about 6.8 to 7% last year, somewhere in that range. Let's just say 2.5. Your market, your area, to get a really good stable tenant's only doing 2.5%. How many people get excited about 2.5%?
On the surface, nobody.
Nobody. Well, we got a $200,000 house just appreciated by 2.5% religiously. How much is 2.5% of 200,000?
$5,000.
$5,000. What percentage of 50,000 is that?
10%.
10%. You just increased your investment of 50,000 by another 10% just by appreciation in a shitty market or a stable market. It's called an extremely stable market, not a shitty market, just extremely stable. You are now at 20.6% growth on your investment. If you had a stock portfolio doing that, would you be bragging at dinner or would you not?
Absolutely.
You'd be freaking pounding your chest and dropping your pants to show how big your investment balls are, right? You show the whole world what you are getting done. But for some reason, we're not seeing that in real estate because we're always looking at cash flow. Now, in this scenario, it said you're getting $100 a month cash flow on this $1,800 a month rent. Not sexy. Nobody's excited, but you get to raise rents. Rents are going up by what? 6% per year? Cut that in shit in half. Let's say it's 3%. What's 3% of $1,800?
Oh, good God. $600. Wait. All right, just hit me with the answer. Now I'm doing redneck math.
Yeah, you just got to take 1,800 times 0.03.
108. Oh, shit.
It's even a little bit high. What's 56? It's $54.
Yep, $54.
$54. Now, are you excited about a $54 increase in your rent?
Again, not on the surface.
Not at all. Here's what's also interesting. Your tenants not excited. How many people are renting 2-bedroom apartments with a $200 a month rent increase right now? But now your tenants in a $200,000 house and they saw $54. You're literally getting your picture on their mantle. They love you. You're not losing that tenant, especially if they're a good tenant you don't want to. But what percentage did your $100 a month cash flow go up by? So this is a massive trick question.
Mathing is hard right now.
54%.
Oh, yeah.
You have double-digit increase on your cash flow, and every year you're doing that, you're getting double-digit increase on your cash flow. What does 5 years look like? You're in that $400 and $500 range in cash flow all of a sudden. Now are you bitching about your cash flow and your cap rates, your cash on cash returns? Not so much. But you're also getting that 20.6. We haven't even gotten to the tax benefits. People need to rethink how you look at an investment property. It's not about your cash flow anymore. When you get suckered into cash flow, you get suckered, period. There's people out there right now screaming that you need to get the 10-year interest only investment deal because this is an investment for the seasoned investor. It's not. It's for the people that's about to get screwed. Because the people preaching that right now, I know those some bitches. Some of them I did their very first loans. They did in 2015 to buy real estate investment. They're not seasoned. They haven't seen cycles. They saw the best interest rates in the history of man to be so-called successful and be a guru right now. Don't listen to them. Do we know the name Warren Buffett, correct?
I believe it's been mentioned a few times around the world.
Couple times, right? You can probably even picture him in your mind what that son bitch looks like. He said the 30-year fixed mortgage is the greatest financial instrument in history because it's the one-way bet. Now, the reason he says that because if the rates go down, you can just refi. If they go up, you protected yourself against adjustment because a lot of people lost everything to adjustable rate mortgages, especially in 2008. Now, his partner, Charlie Munger, do you know that name?
I don't.
He recently passed. He was his partner since the very beginning. He was 90, almost 100 years old when he passed. He was in an interview with Christy Quick in early 2023, and he said in that interview, we saw 40 years of declining interest rates. We're going to see 40 years of increasing interest rates. Interestingly enough, I cannot find that clip anywhere any longer. I've been through 8 hours of footage of that. Nobody has that clip. They've cut that out because they want people to not do the 30-year fixed. Why? When you recalculate this mortgage on this deal, $160,000 mortgage, I've got an app you can download on your iPhone right now. Go find it. It's called the QJO investment tool. What does it stand for? The Quit Jerking Off investment tool. Because if that's all you're chasing is interest rate, that's all you're doing is spending your time jerking off. Now, when you run the calculation on this, you'll find that on a $160,000 loan at today's rates, you'll pay $402,000 in principal and interest. You will be tempted to listen to people that don't understand finance to pay it off early. Do a 15-year payment. Pay an extra $100. Don't do that. I already told you what's going on with the dollar's value. When you recalculate every payment you make for the next 360 months, you're paying a little less and a little less and a little less to where when it all gets said and done, you're paying $154,000 in actual actual dollar value was somebody else's money as you're raising rents and you're getting the house for nothing. Think about that before you move forward on any type of loan. Don't ever talk to a lender who's trying to push you in any direction. Just call me. I'm not going to tell everybody. Just call Aaron Chapman. I don't need to do your deal, but I need you to understand that if you screw yourself, you're going to screw the next few generations. And my grandchildren are part of those generations, and I don't need you making their life miserable. Let me help you set it up front so that doesn't happen to them.
So, Aaron, what 30-year products are available to investors?
All kinds. Just your regular conventional deals. I got DSCR. I got blanket loans. If you want to buy 5 houses on the same street, I can do one loan for all of it. We have 30-year fixes come out of our ass. It's the best instrument out there. And it's not about the rate, guys. It's about stretching out the payment term with somebody else's money.
Yeah, absolutely. So you're actually kind of touching me on a subject that the people that know me well know this, but I owned a hard money lending company for 10 years with my business partner, and we parted ways. He bought me out first of the year. And one of the reasons was because I was always the real estate guy. He was always, loved the lending space, and I wanted to buy and hold more real estate. And we were so buried in our lending company, we weren't buying and holding as many assets as I wanted. And one of the things that I personally, after going through the downturn of 2007 and getting my ass handed to me, I don't use banks. I haven't used a bank for an investment property in 12, 13 years. Everything I've ever done since then is private structuring, private money or structured with the seller of the property. So I say all that to say this: if I jump back into the institutional lending world as a client, as a borrower, the 30-year product would be the only thing that I would be interested in, because I got my ass kicked in 2007 because everything I had was institutionally financed with shit loans.
Adjustable rate deals, right? Were they your pay option arms probably?
The majority of them, yeah.
Yeah, I have those too. I got my ass handed to me. I was suckered into thinking that one of who wins with pay option arms? The banks do. Mm-hmm. They win. Now it seems like they wouldn't because you got all this negative interest and they're getting screwed. No, they're winning in that environment because what they do is the bigger institutions putting the money into the mortgage-backed securities winning, not the little bank who sold the shitty product. Now, what people need to wrap their head around, the banks win when interest rates is the most important part of the deal. The average person's refinancing their primary residence every 4 to 5 years. What's the first 5 years of your 30-year fixed mortgage look like?
Yeah, it's primarily interest.
Primarily interest. But if you can convince people to keep doing that and then add the cost back onto the loan, you're literally increasing, in some cases, increasing their balance, but never paying off the mortgage. I had one guy with a $120,000 loan, paid $38,000 over 48 months, and then refinanced his house to the exact, within $102 of his original balance because the rates went down. If he kept that practice up, he'd have been able to pay for his house twice and never move the mortgage amount. They have you by the nuts when you think interest rate is the most important thing. Get that out of your mindset. Stretch that puppy out. Pay them back as slow as they want it, but don't let them influence you to do it the way they want it done.
Yeah, 100%. 100%. I love this because most people don't want to hear what you're saying because they want to believe that there is an opportunity that interest rates are going to go back down and they're going to be able to spend money like it's water and use their houses as piggy banks. But I've been saying for the last 5 years, I was looking so forward to interest rates going up again because I'm not sorry. It weeds out the weak. It makes the professionals professional again. And, people that got into this business in the last, let's just say 5 years ago, and they bought a couple of houses, they got lucky and they thought that their shit didn't stink. And a lot of them are out there pitching products and selling other people on mentoring and coaching, saying, this is how great I am. But like you said earlier, they haven't seen the ups and downs and the cycles, just like a lot of the mortgage brokers haven't. And, you get a couple cycles under your belt in this business, as you and I have, the end of the movie is pretty obvious. And
very much.
And that's a good thing for us. But, a lot of people want to have their blinders on.
Yes, it's very much the case that so many people that got into the industry since 2008. And guys, if they have not been in this industry before that, you really want to be cautious with it. There's a guy out in Kansas City that's pushing a local bank on the properties he was selling to his investors. And they were doing 10-year fixed, 20-year amortization this was like 8 years ago. and they were doing it like crazy. And I'm just screaming up and down, don't do that shit, don't do that shit, don't do that shit. The market's going to shift. I was offering 3.6% to an investor. They're getting 3.125 from this guy. Like, oh, the market's going to stay here forever. It just has been. And like, you guys are insane. And I couldn't get people to listen. There's such a big jump of them. They've been calling me. They're like, dude, what do we do? Like, suck it up to take the 7 point whatever rate. You don't have a choice. And you're on a 20-year AM. I don't know what more I could have said that you guys wouldn't listen. But somehow this guy made deals to make sure that they closed with his buddy, probably because his buddy was paying him under the table. And it's just sad. It's just sad that that's the situation. You got to listen to the people that have been there. These guys had not been there. None of them had been there.
Yeah, 100%. Well, I want to be respectful of your time, Aaron, and can't tell you how much I appreciate you coming on and sharing all of your knowledge. What's one question I should have asked you that I didn't? And it can be about anything. It doesn't have to be about interest rates or business or anything.
Well, I mean, there's a lot of questions out there. I know a lot of people ask me, it's like, what's created my success? What is my formula to get there? So I'm listening, I don't know until I get there. Right now, it's one of these things I don't ever believe success is ever achieved. You got to keep shaking your ass like you're late on rent every single day because it flips around on you at an instant. Never put your feet up, never relax. Every freaking goal you achieve is the peak of Everest. You don't sit up Everest and crack a beer. That thing will kill you if you sit there too long. Get your ass up and get your ass down and move on to the next one.
Man, that is a great quote. I'm going to have to start using that. Well,
feel free, brother.
Again, I appreciate it. I'd ask you what your social media handles are so people can follow you, but you don't necessarily know. So
I do know one, my Instagram, SGOC_Aaron. You can find me there. I do know that one because, and that's Silverback Gorilla on Coke. That's the way I believe you need to operate your life, is like a coked up silverback. They are, you need to go with that kind of ferocity with how you do everything. And then there's just my website, aaronchapman.com. There's a media section. I've been on, there's the podcast. I do videos twice a week to investors and what's happening in the market and how it affects you as an investor. And then, of course, you can go to your app store and download the QJO investment tool. There's a question mark at the top corner. Goes right to my website. If you can't find that, text me, 602-291-3357. Tell me I need your app and put your email address. Bree will send it to you. That's my assistant. She runs my life.
Yeah, I have an assistant named Tabitha, and she runs my life, but we spell run RUIN. So it's fantastic.
Well, yeah, if you're like, I have to look at my calendar every second to see what she just added.
I can tell you right now that my phone has gone off nonstop since you and I have been doing this show, and I don't even want to know what has been added. So, but man, I appreciate you coming on, and anything that my community at Generations of Wealth can do for you in the future or any of your people, and don't hesitate to reach out and ask.
We'll definitely do that, buddy. I'll be coming back around. We're getting ready to launch the book. You've got the forward and the artwork for the forward in your inbox.
Yeah, 100%. We'd love to have you back. So
thanks, man.
So we'll wrap this one up. Everybody that's a regular on the Generations of Wealth podcast, thanks for listening. If it's your first time, thanks for being here. You can always go back on thegenerationsofwealth.com and listen to all of our shows previously released and look for everything else that we have going on, including Circle of Trust Mastermind, the Generations of Wealth Voyage, which is the conference at sea, and my negotiations training, No Means Not Yet. Until the next show, go out there, live your vision, love your life. See ya.
Thank you for joining us on another insightful episode of Generations of Wealth. May your newfound knowledge help you in leveling up your own strategies to get through the many obstacles to your money-making processes and bring you much closer to the financially secure life you truly deserve. Continue filling up your accounts and further polish your financial tactics by listening to more episodes of the podcast at thegenerationsofwealth.com. Because in your wealth-building journey, there is no other way to go but up, giving you the chance to finally live your vision, love your life. That's all for now. See you on the next one.